Okay, good afternoon, ladies and gents, and welcome to MACROACE with your host Tony. Just going to go through FMC, give you a bit of a breakdown. Rate is expected to remain unchanged at 5.5%, but there will be the summary of economic projections, which we'll need to focus and see whether the Federal Reserve decides to stick with the 3 rate cuts for this year, or if there is a bit of a surprise of them maybe going towards 2 rate cuts this year instead. And also their expectations of where they see the Fed funds rate in the future as well. So let's get right into it and go through some of these things you need to know. First of all, what is the rate decision? Well, it's the Fed members that meet roughly every 6 weeks over 2 days, and that's where they set the policy and federal fund target range as well. So the rate that they set, it's the rate that the banks charge each other to borrow or lend excess reserves overnight. So why is it important? Well, for obvious reasons, the interest rate decision, depending on which way it goes or depending on what is said, whether the central bank is more hawkish or dovish, can cause a lot of volatile moves within the markets. And then, of course, the wider economy, not just the US economy, but also the global economy too, because a lot of the other central banks, they will then take heed as to what the US central bank is doing and then try to mold their monetary policy around them. Besides some of these central banks, such as the ECB or the Bank of Japan or the Bank of England, they haven't really followed suit entirely as to what the Federal Reserve has done, but more or less with the Bank of England, the ECB, the RBA, and RBNZ, it's more or less been similar with the tightening cycle. Then how does it affect the markets? So in the short term, for the currency, if for whatever reason the central bank raises interest rates higher than if it's higher than expected, or if they're more hawkish than expected, then you'd expect an appreciation within the currency, because that means that the currency is going to be valued at a higher rate, and you will have international traders that will jump in and will jump into a currency that will then provide them a better return on interest if they jump into a government bond or whatever it may be they jump into, but particularly government bonds if they get high rates of interest. So for the currency, if the central bank is more hawkish than expected, you'd expect a more bullish reaction from the dollar. On the flip side, for the stock market, though, if you do see the central bank that, let's say, is more dovish than expected, i.e. that they're looking to support the economy, or there aren't that many hawkish comments that are provided by the central bank, or if they expect more rate cuts, let's say for this current meeting, if they expect more rate cuts this year, which probably is very, very slim that could occur, but you never know. And then that would provide some upside movement or boost to the stock market instead, and more of a bullish reaction from a more dovish than expected central bank. So not only, today of course the meeting is for a pause, but in general, usually for interest rates, you keep an eye on what the rate is and what the monetary policy statement says, and anything else that is put alongside that to then make your decision as to which way you're going to trade. And that is quite difficult to try and do in a short amount of time. So the summary of economic projections does make it a bit easier, because there is a single sort of focus on where they see the interest rate being within the future. How many rate cuts do the central bankers see within their dot plot for this year? Do they see less or more? It's pretty simple in that regard. But weeding through all the comments, let's say all the paragraphs, then makes it a bit difficult in that way. So more or less, it's a wait and see. You've got to read what the statement has said, understand it before you make a decision. For the bond market, usually what happens if the central bank, let's say, is more hawkish than expected for bond yields, that will tend to lean towards bond yields moving towards the upside, seeing a bullish reaction instead, because the central bank is looking to maybe be more restrictive with the monetary policy, or maybe being restrictive with the monetary policy for longer than what traders might be expecting. Or there is the hope for bond traders, for those who are trading the bond yields, that the central bank might raise interest rates again, and then that will then raise the value of those bonds and their yield. So that's something just to be aware of. When I say the value of the bond, I'm talking about the rate that it provides, not the price, because usually when rates go higher and bond yields go higher, the price goes lower to attract investors and traders to it. Okay. I won't be staying for the speech. No. Yeah, it will just be the statements. I'll quickly run through it myself. And then I'll see whether or not it's something that I should trade or not. So it's going to take a little bit more time for me to kind of take it into to kind of factor in what I should do. So where's the economy at the moment? FOMC statement, Nani. So that would be in about 53 minutes time. Okay, so where's the economy at the moment? So GDP Q4 3.2% compared to 4.9%. Inflation at 3.2% compared to 3.1%. Core inflation at 3.8% compared to 3.9%. PC price index at 2.4% compared to 2.6%. Core PC price index at 2.8% compared to 2.9%. So these key readings here with... Okay, the headline inflation figure did tick up by 0.1%, but there wasn't... For the markets at the time of that release, when that had occurred, yes, there was a decline on the S&P 500, but then as soon as it had declined on the next candle, it started to make its way back up instead. Didn't really see that much movement from it. Or pretty soon it started to reverse its course, because traders were still pricing in June for the first rate cut from the Federal Reserve. So it didn't really change traders' outlook for the interest rates, for the first interest rate cut that they see this year. However, core still, although it may be decline, maybe not as fast enough as what the Fed might want to see in regards to disinflation. So that would be something that would be picked up in maybe the revisions for the SEP and what they see for the future. So PC price index data, a little bit better with the inflation on that side, and looking at the US as a whole rather than just in the urban areas. Consumer spending at 2% compared to 0.7. Non-farm payrolls at 275k compared to 229. ISM manufacturing PMI 47.8 compared to 49.1. Services at 50.6 compared to 52.7. University of Michigan sentiment at 76.5 compared to 76.9. UMich 1-year inflation expectations unchanged at 3%. And the 5-year inflation expectations unchanged at 2.9%. And then employment cost ticked down to 0.9% compared to 1%. So the services sector is something that is always something that the Federal Reserve members do talk about as it was an issue, or may still present an issue for a stickier inflation. So if there are more jobs being created, or there is more activity within the services side of the economy, that means it may make it a bit more difficult to bring inflation down in a nice and easy way, and you get more of these bumps, like we'd seen with the last inflation print. But markets still believe, as said, that June, although according to Fed futures, they still see about a 55% chance of a June Fed rate cut instead. It used to be about 64, not to about a couple of weeks ago, but that's kind of dropping down as reality may set in that there may be a little bit more time that is needed for the Federal Reserve to feel more confident. So that's going to be key here. Does the Federal Reserve repeat the rhetoric that they need to feel more confident that inflation is coming down before they make the decision to cut interest rates? Okay, that's going to be key for specific headlines that we need to look out for. If that's repeated, that might act as a bit of a bummer for some traders. But usually, what happens if you do get repeated headlines or rhetoric, traders would have maybe they're already expecting it. It's nothing new that's being added, so there might not be too much of a reaction on that side there. Previous FOMC's summary then on January 31st. So the committee judged that risks to achieving its employment and inflation goals are moving into better balance and the economic outlook is uncertain. They don't expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards the 2% goal. So that comment is going to be quite key. Do they repeat it in the same way that they don't expect it will be appropriate to reduce the target range until it has gained greater confidence? Or do they say that they are gaining some confidence that inflation is headed towards the 2% goal? What you're looking for is, within that sentence, is confidence. If you're looking to see a more dovish side from the Federal Reserve, is are they gaining more confidence with inflation? So it's hard to predict what they could say with their language and how they could change it to show that. But as I said, if they say that they have some confidence that inflation is headed towards the 2% goal, but more time is needed, that might be enough to provide some bullish support for the stock market. They also said that recent indicators suggest that economic activity has been expanding at a solid pace. All right. Okay. So the Fed minutes then. Fed minutes summary on February 21st. So from that, they said staff placed some weight on the chance that further progress on lowering inflation could take longer than expected. Staff economic outlook was slightly stronger than the December projection. A couple of policymakers pointed toward downside risks from maintaining an overly restrictive stance for too long. Some officials noted progress on inflation could stall, and the last print that we had from CPI, I mean, compared to market expectations, it's still kind of going down, but it's a little bit sticky. So you could say that it's kind of stalled there, but that's only one reading. So we've got a few more left before the June meeting. They also said that most Fed policymakers noted risks of easing too quickly and emphasized the importance of incoming data in judging if inflation is moving sustainably towards 2%. Now, I sound like a broken record, but if they say that inflation is moving sustainably towards 2%, that's a big old jump from not feeling confident to then feeling confident. So that would provide a big old potential big old boost for bullish sentiment for the stock market and a bearish reaction for the dollar instead. So the first rate cut could maybe happen in May rather than in June, or you could see pricing and speculation going towards May from June instead. So that could be the possibility, but they might temper that with saying that they might need to see other areas too that need to kind of cool down. So instead of traders maybe going towards April as a date for when the Federal Reserve decides to cut interest rates. April would be crazy if the markets start pricing that in. If that happens, then you'd of course expect a lot of volatility, which will then provide you more opportunities to then jump into a trade. All right, Fed member comments then. Several members reiterated Powell's January FOMC comments that it will likely be appropriate to begin dialing back policy restraints at some point this year. You had a few members that noted progress was likely going to be bumpy, but continued to expect inflation to come down to the 2% goal. Fed's Logan noted that a slow pace of balance sheet runoff would allow the FOMC to more carefully judge when balance sheet reduction had gone far enough. And I don't think the balance sheet discussion is going to come into play until the Federal Reserve for maybe a couple of meetings or two before the Federal Reserve has made a decision when to cut interest rates. So that might take a little bit longer. So several participants commented that the risks of under and over tightening appeared to be balanced. That a few, including Governor Waller, suggested that the risk of waiting a little longer to ease policy is lower than the risk of acting too soon. Hence, you have the pricing in for the second half of the year for June for the first rate cut from the markets. Right, so investment bank views. Deutsche Bank, they said on the 13th of March that in terms of implications for the Fed, while the core print was only a few basis points higher than expected, this is referring to the data before, I think that the component level data did little to provide FOMC participants with further confidence that they can begin the process of normalizing policy. And indeed, this data should better eliminate prospects of a cut before June, absent an unexpected softening in the economy. Okay. Goldman Sachs, they said that they expect the Fed to leave the Fed funds rate unchanged at this meeting and continue to see rate cuts in June. Central banks face the same issues of being confident of disinflation process, and they still believe that central banks will still make the same decision of when to cut rates. So when I was talking about the Deutsche Bank one, that was referring to, of course, the latest US CPI data. So I said central banks from Goldman Sachs say they face the same issue of being confident of disinflation process for central banks. ING say the market reaction has been very contained compared to a month ago when inflation surprised by a similar margin. Indeed, the actual whisper number was close to 0.4%, this is referring to the month-on-month, but that does not make the rally in US equities after the release any less surprising. They think, instead, that markets continue to rely quite heavily on Powell's relatively dovish testimony, which has made rate cut expectations arguably stickier. So the reconfirmation of the dovish rhetoric that's been provided by Powell has meant that the release that we had last week for CPI, which would have generally seen a much stronger initial reaction and maybe more of a continued reaction, actually was moderated by the expectation from the markets that a Fed rate cut in June will happen. So that's something to be aware of, is that if Powell reiterates what he said at the last meeting and also at his testimony, that maybe inflation, if inflation is headed towards its 2% goal, then that would probably be enough to kind of keep markets. Maybe you might not see too much. You might not see too much happening. Highly unlikely Powell saying stuff like that. No, this is just. Yeah, I think so. I think you might misunderstand. This is just the scenarios of what could be said from Powell. Got to be prepared for everything. So, yeah. Does that make it clear? Hopefully it does. All right. So, Wells Fargo, they said that they now expect the Fed to start cut rates in June versus May is what they expected earlier. So this was post the inflation data, more or less hasn't really changed. Let's go to the market pricing then. So on March 8th, traders still see June start to Fed rate cuts after the jobs report, with about 30% chance of starting in May 1st. 15th of March, Fed Fund futures saw about 52% for June from 64%, and 3 cuts priced in for the year from 4 after the CPI and PPI data combined together a day after the other, or within the same week. So that's something that's quite important, is that if the Federal Reserve, if they decide to, in their summary of economic projections, see 2 rate cuts rather than 3, that could then damage those that would definitely have an impact and damage the expectations for rate cuts in the future, maybe even June instead. And it could mean that the Federal Reserve starts later on, maybe in July, instead of June. So this is the last release that we had. So this is about 10 seconds before that, before we had the data from the Federal Reserve. Didn't have the summary of economic projections, so there wasn't much to go off of other than just the statement to try and weed through and then look through what's going to be, or what's going to be important, or what is new or old. So okay, so rate comes out, you see a lot of whipsawing from the markets, from the data. And if I bring up the ranges and deviations sheet, that we can have a look as to the reason as to why this sort of market reaction may have occurred. So if you do have access to the Google ranges and deviations sheet, you'll know, and I'll bring it up on the screen in a bit, but you'll know that it'll go through how big the market reactions have, or how much the markets have reacted to economic releases. For central banks, the key focus is what's said that's caused the markets to react in a certain way, and that's it. And then you also have that together as well. Let me just try to find it here. There it is. I was already clicked on it. All right, skip forward. So yeah, you can see that market reaction more or less held itself for a little bit, albeit it wasn't. If I kind of keep going forward, we go to deviations. Let's show what we had there. Let's close that out. Okay. So this is the last meeting here. You can see that the initial move. So if you're unfamiliar with what this is showing you with all these numbers. So that said, the Google ranges and deviations sheet shows you how much the markets have reacted to economic releases, and with interest rates, we go through what the sentiment was, or what may have caused the move. So here we go. So the last one we had is that the Fed does not expect it will be appropriate to reduce rates until there is greater confidence inflation is moving sustainably towards 2%. They remove the reference to potential additional additional policy firming, and the market's rate futures traders keep bets for first Fed rate cut to come in March. Back then, on January 31st, of course, that's changed dramatically in a short amount of time. But here we go. So the initial market reaction was quite choppy because you had the hawkish commentary. The Fed doesn't expect it's they're ready to reduce rates. But then you have the dovish commentary that they remove the reference to potential additional policy firming. So it was moderated. Hence you had the initial mixed reaction, where you might have seen here. So this shows you on the first candle, okay, on a 1 minute chart, the initial market reaction. So initially, there was about an 18 tick move towards the upside, and then 53 tick move down. In the black brackets represents a move 10 minutes after the release has occurred, going to the end of the candle. And in the in the blue brackets represents the move 30 minutes after the economic release has occurred, again going to the end of the candle. So this is a simpler version here. Okay, so this is again the initial market reaction, go to the wick of the candle, 10 minutes in the black brackets, and then 30 minutes in the blue brackets. Okay, so just one thing to note, if you do see where here, for example, okay, where there is a reversal that has occurred, so you can see here initially there was an 81 tick move down, but then after 10 minutes of trading, the S&P 500 was 34 ticks up from the release. So that shows you if it has a word within the brackets, any of the brackets, whether it be blue or black, that means that there has been a reversal that has occurred. I think there's something that people might be confused by or may not have understood fully, but hopefully that makes it clear. Why Eagle FX? There are a lot of comments here, buddy. What was your question? Oh, there you are. Okay. What happens if it stays the same? If it stays, so if the rate stays the same, that's if the rate stays the same, then there's not much to go off of, right? What you're looking for is, so if the statement remains the same, okay, and the summary of economic projections also remains the same, that they still see 3 rate cuts for the year, then you might get more or less a mixed reaction, i.e. you might just get a bit of a whipsaw, and then the markets will carry on with what they're doing. So if there are no surprises, you're not really going to get too much out of the market, potentially. Connell says an image tile summarizing the relevant candle for each cell would be nice enhancement, similar to what we see in the news feed on FinancialJuice. An image tile. Okay. Send me an email, Connell. Turn your FinancialJuice, and I'll. Okay, that's the email. Just send me an email there, and then I can have a little look. But just send me your idea so I don't forget. Oh yeah. Add an image for each pair. Yeah. All right. So as I was saying, so let's go through this. We still got plenty of time. We've got about over half an hour. But let me get through this little bit here, and we'll do like a little questionnaire thing. We've still got this previous summary of economic projections to look at too. So if we're looking at the biggest market move or in the currency pair, what's had the biggest market reaction? It typically, as historically, has been the dollar yen, which has seen the biggest move. That's because the central bank in Japan had been easing their monetary policy. Now it's different. Now that the central bank is starting to has already raised the interest rate between between a target of 0% to 0.1%. What that could mean is that the roles are being reversed. The central bank, the Federal Reserve, is looking to ease monetary policy. The Bank of Japan going the other way around. So that means that the volatility is still going to be there, and that the dollar yen could still see the biggest market reaction overall compared to all the other currency pairs, all the other currencies against the dollar. So here, what we'd seen last time, albeit it wasn't as big as it was last time round, with the choppiness in the pricing in of what the Fed is going to do with the initial market reactions. Historically, the dollar yen has seen the biggest movement in the past in the currency space. Then in the bonds, we're looking at the 2-year bond price. The 2-year is the most sensitive to interest rate decisions and movements within the markets and pricing expectations. So that's going to be given there. So the 2-year bond price has seen the biggest market reaction there. Even with Bitcoin, okay, Bitcoin kind of does its own thing, but it's always interesting to take note of what it does with the FOMC being a risk asset. All right, so that is the says, let's just trade random pairs with the extra time that we have. Yeah, maybe maybe not a good idea. Or we might take like a little, we could do like a little intermission, and you can hear, I don't know, and some elevator music. Do 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 do. Please stand clear of the doors. We are now approaching the 4th floor. Do 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 do. All right, that's enough of that. So if you want access to the ranges and deviations Google Sheet, all you've got to do is have a little look at the. You've got to sign up to the MACROACE mailing list. Now you'll get an email on Monday to be able to see to be able to have access to the Google ranges and deviations sheet. Not only did we cover the Fed rate decision, but you can see we've got the Bank of Canada, ADP. We did cover it, but it hasn't really had that much of a market reaction. You'll see that there might be a lot of releases that we might have covered in the past that are not being covered anymore, because either the market reaction has it's either lost its allure, it's not really having that much of a big market reaction, or traders are not really that interested as they were into it before. But there are a range of different releases that we cover and have a little look at. Tomorrow, of course, we've got the Bank of England interest rate decision, so that's also a good opportunity to have a little jump on and trade sterling and see how it goes. Have been surprises. I mean, look, there was GPJPY on the Dragon. It was 94.5 pips down on the initial market reaction from the data. Okay, so it can present an opportunity, but you just got to get up early in the morning. And I want more people on the stream. It's okay. You guys do what you want to do. But yes, you can see there are a wide variety of releases that are covered or have been covered. They look at the historical data. We're doing less so now because there aren't too many things that the markets are focusing on, besides inflation and jobs and interest rates. And or the ones that cause the biggest market reactions or have the potential to cause the biggest market reactions, like non-farm or CPI or interest rates. Okay. I think somebody did have a recommendation or a suggestion, is to have, actually this is something I should have done before, is to have the other economic releases, not just for the US session, but for, let's say, in Australia, with the RBA rate decision or the RBNZ and the Australian employment data too. Maybe that should also be in there too. Would you guys like to see more of the other countries? Would you like to see more of the other countries, like Australia and New Zealand, and their interest rate decisions in the deviations and ranges? Will that help you guys? Will that make the deviations and ranges sheet more useful? Okay, yes, Pulmatur, Pulamta, Denzel says yes. Motoban says, will the dollar yen reversal be as great as the uptrend, given that the interest rate differential and pace of cuts versus hike might still favor the dollar? Kind of can't really predict that. Well, the only thing you can do. So let's get off this here. Information over. Braha Prema Das says, Aussie, 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 oi, oi, oi. Okay. Let's have a little look. So if we're looking at the dollar yen, Usually, I kind of trade the NQ or the S&P 500. Rarely do I go to the currency pair, but let's go on an hourly, see what we got. Okay, that's not going to help. Nope, that's going to be too much. No, just hide a certain selection. Let's go. See what we got. Let's put these on here. Well, it's definitely not going to go there. It's too much. Okay, I think that's enough. And then we'll kind of do a little bit of a breakdown. Make that a bit accurate. Okay, actually, that is interesting. So, I mean, that'd take a lot for it to go around there, but zoom out. Whoops, it's good. Okay. Okay. All right. So that's about 15168. Let's say if the Federal Reserve sees only 2 rate cuts, there is the potential for it to bounce from this area at around, let's see, 15154 potentially. If they see less rate cuts, or if they see inflation actually being a bit higher this year than they would have expected in the past, with a more hawkish than expected central bank, and if they repeat the rhetoric, maybe on top of that, the repeated rhetoric, rather than it just being by itself, or then them not being confident that inflation is headed towards a 2% goal, or needing more confidence for inflation that inflation is headed towards 2% goal, could maybe have a move towards this level of resistance at 15161 potentially. But the other areas, it kind of looks like there needs to be like a lot of work, or a lot of a big surprise to happen for the markets to kind of go, for it to go past this level of resistance. But for the support area, I mean, it's kind of holding. Yeah, let me just do one more little line. All. Yeah. And that, I'll mess that up. All right, we'll leave that there. So I've kind of answered your question, then I haven't answered your question. So I hope that kind of helps on that there, though, with the dollar yen. Probably lost the comment now. Where has it gone? Modi Bain. Hope that kind of helps with what you've got. We've got there, or what with your question. Okay, so Financial Juice then. Financial Juice is where we will be getting the headlines from James, our very own guy who's on The Voice. Okay, he will be so Financial Juice. If you're unfamiliar with what it is a live voice and text service providing you with up-to-date news of what's going on within the markets, what are central bankers saying, any geopolitical conflicts, or in certain areas if there are conflicts, and keeping you up to date with what's going on around the world, all in one place, on one platform, newsfeed, via voice and text. So here we have our live voice feed here. You can see, you should be able to see me kind of scrolling that there. In the center, we have our text headlines. Nagel says, I'm more worried about Europe being the sick man than Germany, because of course they've been called the sick man of Europe. which doesn't make sense. No, that's a bit silly. But yeah, so here we go. So you have the news headlines here in the center. On the left-hand side, you have your economic calendar of what to expect for the day ahead and also the week ahead as well. And that's all in one place. So if you're a day trader and you're looking to capitalize on those opportunities that do present themselves, then, I mean, any sort of news that's going to move the markets is what's going to be important to you. And we have a macro focus on that, i.e., looking at it from a global point of view. So we know the Fed is going to move the markets as a whole, or a central bank is going to move, let's say, the Bank of England tomorrow, the pound and the UK stock market as a whole. Those sort of things is what we do have a focus on, and of course the large companies too, particularly the US companies, is what FinancialJuice has a focus on. But this is, as said, this is the pro version of FinancialJuice that you can see here. It's all in real time. There's no delay. And as soon as the news hits, we hit you too. That sounds bad. We're going to punch you. But I'm saying we're quick, okay? So with the news, and you're informed and you are kept up to date with what's going on. So if you want to get the chance, or if you want to sign up to the pro version of FinancialJuice, okay, we have a current offer for a March Madness. So instead of paying FinancialJuice for 1 year for about $1,100, you get 92% off, and you can pay $99 for a year's worth instead. So instead of paying $1,100 for a year, you're paying $99 for a year for a year's worth of our service. With it, so it's a 92% discount altogether. So here we go. That is the link there. We are fast because we have turbo shoes. No, it's So we're quite fast. All right, so that is the link there to the pricing, and here we go. That's March Madness. Yes, it is an insane account, but it is there for you. FJ for 1 year for $99 and 92% discount. What? Instead of paying $1,100, what? You're paying $99 for a year. Anyway, now before you decide to make your payment, or if you make your subscription, first what you got to do is subscribe to FinancialJuice. Okay, and that will take you to the light version of FJ, okay, which is here. So set up your account first on FinancialJuice on the light version, which will give you your login details, verify your account through your email. Once you've done that, then select the subscription that you want. Once you've done that, then go back and you've paid, log out of FinancialJuice and then log back in, and then you should see the beautiful pro version of FinancialJuice. Now, the light version of FinancialJuice, there is a delay across the site, but it doesn't mean it's not useful. If you've never come across a live voice or text service before, or you're not sure how to incorporate it within your trading or your day trading, then have a little play with the free version first. Yeah, there is a bit of a delay, but it's still useful enough to kind of give you an understanding of what it can do. Okay, having that ability to stay in the know and be on the bleeding edge of news of what's going on within the markets and the news as well. So, but for anyone who wants to pay for it and you haven't got an account, make sure you have an account first, because if you don't and then you pay for it, then there's going to be some issues within trying to get you sorted out. And that's pain that you don't want, and neither do we. It's not fun for us. No way. So make a free account, FJ Lite account, then select your subscription and then pay. But of course, do that if you feel ready, or stay on the live version, have a little play with that and see what you think. Also, on top of that, you have access to the news desks, so you can ask myself or the other people who are working on the service what's going on with the markets, or what has happened in the markets, or what to expect maybe event-wise, if it isn't there on the calendar, or if you may have heard something. Is it true? Or so on and so on. We're here to kind of answer your questions, not just with what's going on with the markets, but also if there may be a technical issue too with the site that you have for pro users. Okay, all right. Well, there isn't a March Madness in the UK, but I mean, you want to start one? We can start one here. I mean, I'm all down for it. Make my Wednesday evening much more fun. So with the widgets, if you're talking about the TickStrike widget, so everything has a delay to it. Everything. So if you're pro, it's all live in real time. But from the delay version, if you're on the light version, everything has a delay. It's included in the newsfeed and the economic calendar on the left hand side and voice. TickStrike, I think that there is, but yeah, but that's restricted anyway, whether you're pro or not. And we'll go through TickStrike later on for about 15 minutes. Let's see. Who put like a bean eating contest or something? What did I miss? You guys. So with the daily imbalances, so I said with the data, there's some issues with that and what's available now to us, but also what customers have been saying in the past that they've been using over the time. They've been using the final mock as the read for the final mock data compared to the early mock data. So I know you've asked that question a couple of times now, but yeah, that's but yeah, so that's that should answer that there. So stuff with the data side that has changed, and also custom feedback of what we've heard, what has been told to us. Hopefully that answers your question on the mock data. Okay, let's see. So yes, one final thing: summary of economic projections. I do want to go through that. That is very important. Here we go. Let's bring that up. So this is the last one in December. So you can see that the Fed funds rate, that the expectation for 2024 for the rate was reverted back to the June to the previous SEP to that. Okay. And that's what caused the markets to. That's what caused, first of all, if I bring that back up, actually, if I believe the markets to see a decline because of how the data was. So they're seeing less rate cuts happening. It had gone up because they had seen more rate cuts in 2024 compared to the previous SEP. Let's say if they see that going, if they expect that rate, as if it sticks around 4.6, this is currently looking at three rate cuts here. Okay, that 4.6 for 2024. If they see 2, then that could mean that we're looking at around 4.9 or 5. Okay, potentially around there. But if they are still looking at 3, and if they do go with the March Madness and go with 4 rate cuts for 2024, then you'd see a way smaller figure here. You'd probably see around 4.4, maybe 4, going towards the low end of 4 instead. inflation, that's also going to be important too. Do they see smaller than expected? Do they see inflation being smaller than expected or lower than expected for PCE and core PCE as well? But the focus is going to be, what do they see in 2024? Have they adjusted their thinking? Okay. Cool. We got about 10 minutes left. So yeah. So Fed Fund Futures is going to be the first thing we'll try and look out for. Do they see a higher figure, or do they see a lower figure? If they see a lower figure, that means that there's going to be more easing expected within the year. If they see a higher figure, that means there's going to be less easing expected for the year, and then may also put traders off with the idea of a June rate cut potentially, and then move that forward instead. If that is the hawkish scenario that then occurs, and then the inflation numbers would be secondary to see whether or not the central bank sees inflation being higher or lower in the future. Okay, so I'm gonna I'm sure you guys can see this already, but we've got about 9 minutes left. I am going to I'm just going to pop out for a second. I'll be back in a little bit, but I'll leave that here for you to have a little look at, and then kind of take it in. Okay, speak to you in a bit. Okay, I'm back. Just gave the team a little bit of a pep talk. Like the Mighty Ducks. I mean, I haven't watched maybe I did watch that film a while ago. I haven't, but it's been a while. Okay, about 5 minutes left. So, Okay, we've got the S&P. Looking at that, dollar yen. Okay, looks gold here, top right. And then we have the news feed on the bottom here. Okay. So, also the Bank of Canada as well. Indicators of underlying inflation, slow progress, getting inflation down to target. Okay. Here's a quick check. Okay. Nada. Yeah, this is going to be... Show us what you take and need to rush. That's if I decide to take a position first. But I've got to read through what the statement says. I can't just jump in. That might take me a little bit of time. Hopefully it doesn't, and I'm able to kind of weed through it as quickly as I can. But for now, well, it's not a figure. So, well, I mean, it's not just a figure by itself. So it's of course. Anyway, you know that it's a lot more complicated. Hopefully, we'll see. And then you gotta wait to see if it actually works. So, and if it doesn't work, then okay, so be it. On to the next one. Let's see. What are my deviations? Sorry, I'm just getting myself set up. So just looking at my deviations again. Okay, it's choppy. Very, very choppy. But it was mixed. So it could turn out to be a know-nothing release as well. Maybe. It's not that it's not that it isn't going to cause some market movement, but it might just be that it might be a repeat of the same rhetoric. The S&P doesn't give anything new, and then you just see a big old whipsaw, and that's it. And the markets just kind of tail off. So, yeah. FJ sheets with a sheet he provided. I don't know what sheet you're talking about, but if you're talking about the deviations, that's what I've done. Unless you're talking about to the tick. Yeah, I'm not sure what you're referring to. He makes sheets. I make sheets. Okay, 1 minute to go. I'm gonna go silent now, so I'll be reading through what's being said, and then I'll make my own decision, and we'll see what happens. Okay. All right. Good luck to everyone else as well. Also, don't forget to give the video a like, subscribe to the channel, get the word out there. Okay, got 18 seconds. All right, now I'm going to go quiet. Okay, we'll make this last little trade. So keep an eye on the TICKSTRIKE. May work, may not. Let's see how much this reaction goes. So with the market reactions, so if I quickly go through. Oh. So I'll let that go ahead. It's okay. Probably gonna kick me out. All right, fine. So good. So Fed officials median view of Fed funds rate at the end of 2025 at 3.9 compared to 3.6. See what else we got here. 9 of 19 officials see policy rate above 4.6% median forecast 2024. Fed projections imply 75 basis points of rate cuts in 2024 from the current level and an additional 75 basis points in 2025. So let's bring the... let me bring it up. Okay. Okay. Cool. No. PDF. So this is the current one. I'll just bring that out of the way. Let's close that. Let's get that out of the way. Okay. Let's get TICKSTRIKE out of the way. Okay. Okay, so they saw slightly, so in 2025, slightly higher rates for, and also for 2026. 2024 stays unchanged at 4.6%. So what the markets were expecting, looking at 3 rate cuts for 2023. That's what's going to happen. 75 basis points worth of rate cuts is what they see happening, still as their base case. Inflation, core PC seen slightly higher. PC, headline PC seen lower. Unemployment rate seen lower. Real GDP seen higher as well. Okay. All right. So let's see. So Fed's, okay, here we go. Let me just see what was that there. So traders price an additional easing, Fed easing in 2024. Okay. See. Let's give that there. Okay. So that's a way that you can use a Squawk to a live voice and text feed to keep up to date with what the markets might be doing. Definitely broke through that. Let's get that out of the way. Whoops. Okay. All right. How did everyone else do? So okay, 2 trades I done well with. One which didn't go my way. But how else did everyone do? Crazy Foxy says Powell will have to jawbone hard if he doesn't want financial conditions to continue to ease. I mean, it's kind of being implied now. So, oh, by the way, I'm done with today. That was 3, and I'm done for it. Yeah. So, as I said, if you found the information useful, don't forget to like and share and subscribe to the channel. Get the word out there. And yeah, share the video. But okay, good. If you're on the Dow, you got 60 ticks on gold. 60 ticks. When you're referring to pips, you're confusing me. I think you meant ticks. Mark J got a nice option trade up for good profit. Good. on the SPY as well. Oh yeah, so $6. Yeah, okay, good, nice. That's pretty sweet. That's sweet. Okay. So yeah, let's go through TICKSTRIKE. So TICKSTRIKE, what it allows you to do, what it does is it shows you how strong is the buying or selling momentum within the markets. And what it does here, so if I bring up this ticker box, this box here, let's go for the S&P 500 or the ES, okay, representing the current contract. Okay, there's you can see that there is, so this number here represents the selling momentum with a minus figure. And if it's a plus figure, it shows you that there is buying momentum. Okay, this box there is a sensitivity that you can set on it. What do I mean by that? So level 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that goes on, then TICKSTRIKE, as you can see here, will give you a visual and audio alert to what's going on within the markets. How strong is the buying or selling momentum? But if you only want to see when there is a big amount of buying or selling momentum that is going on, then what you do is you can switch it up and drag that slider all the way to 15. Okay, 15 is the least sensitive to market reactions. So only when there's a lot of buying or selling momentum that is going on for that time, only then will TICKSTRIKE give you a visual and audio alert to what's going on. Or you can just you can do both, visual and audio. I choose to do both because yeah, that's what helps me. But as said, so you can kind of chop and change that and do what you want with the level of sensitivity of what you're looking for, whatever works for you. But again, it visually and audibly shows you how strong the buying or selling momentum is within that asset. And that asset could be in FX, stocks, it could be any asset in the futures market, or majority of the assets in the futures market. It could also be a cryptocurrency as well, your ETFs and ETNs, and your internals too, like the VIX index. They can have a little look at. Okay, so that's what TICKSTRIKE covers. Now, for those who scalp, so this tool is made for day traders, right? Capitalizing on potential opportunities and managing your own risk. Now, there's one more tool that would be that is something that can be very useful to those who scalp the markets. I don't know if you've been in the past streams, but you might know already what I'm talking about or referring to. It is the lightning bolt version of TICKSTRIKE. Now, before I let it do its magic and thing, the lightning bolt version of TICKSTRIKE is uber sensitive. So if I said 1 is the most sensitive to market reactions, when there's a little bit of buying or selling that's going on, or every little bit of buying that's selling that's going on, the lightning bolt version captures every single bit of buying or selling that is going on. So you see crazy little moves happening, and you get alerts visually and audibly, or whichever way you want to go, either visual or audio, about this buying and selling strength within the market. So you can capitalize on those little potential opportunities that come your way. Now, I'm going to move away the mouse, and you'll see how crazy it is. Okay, so yeah, there you go. That's on. So remember, I said level 1 is the most sensitive. With the lightning bolt, you've gone 15 levels below 1, so it's uber sensitive. So for me, okay, this is my style. But for someone else who likes to scalp the markets in an extreme way, then that is there for you to have a little look at and play with. Okay, and of course, you can still do the same thing. You can kind of chop and change the sensitivity. So you're going from, let's say here, you're at minus 15, and you're going all the way back up to 1, right? That's what you can do there, and chop and change whatever you feel like works for you. Yeah, that is the lightning bolt version of TICKSTRIKE. Now, if you'd like to get your hands on TICKSTRIKE, the pro version, there you go. That is a link to TickStrike there. There's also one other thing. Now, there's a free version of TickStrike, but that's limited. And when I say limited, it's limited to 4 assets: S&P, Eurodollar, oil, and Bitcoin. And the strength or the so the level of sensitivity restricted to, I think, about 6. And you can't chop and change that to suit whatever your trading style is. But that is there for you to have a little look at, to have a little play with. That's on the pro version and live version of FinancialJuice, by the way. So have a little play with it, see what you think. If it works for you, then you have the link there for TickStrike for the pro version to sign up to that. And then you can kind of do what I've done, is kind of move around and set my tickers to whatever I feel comfortable with, okay, or whatever I want. Okay. Of course, you do whatever you want to do, or whatever way works for you. So do that there. But yeah, let me just bring this here for you guys. Okay, so this is the, let's say, the terminal there for TickStrike. So it said you got Forex, you got crypto, futures, whoops. You got your stocks as well. And move the other way, you got your ETFs and ETNs and your internals. And then to see what current tickers you have accessed or have open, just click on active. And there you go. You've got your list there. Okay. Let's move the other way. All right. So that's TickStrike. Now, tomorrow we have the Bank of England interest rate decision. Yeah, you might have to get up earlier, or maybe you are already up, or you're just getting ready, you're going through your sheets or whatever it may be. But the Bank of England, I'm not going to say it is going to present an opportunity. I'm saying it can. And I also want more people on the live stream, so yeah. But yeah, it can present some opportunities. But let me get the live link for that for tomorrow. As I said, if you found this live stream useful, the information that's been provided here useful, don't forget to give the video a like, share, and subscribe to the channel. Get the word out there. Let me just find it here. Here we go. Yep. That's the link there. Okay, for tomorrow for the Bank of England. White Eagle FX. So everything is bullish. What do you think? Well, I'll take with what the markets have said, what they feel. So if let me just bring it up here again. Where is it? So if they are baking in, if they are baking in, if the markets are baking in one more Fed cut, then that's what's causing, helping to cause a move towards the upside, or the initial move that we had seen. So again, traders price in additional Fed easing in 2024. Nick Timmer speaks from the Wall Street Journal, says a few FMC officials see upside risks to the unemployment forecast compared with December, but more of them see upside risks to the inflation forecasts. Okay, so that's something that could be tempering this upside move that we see here from the markets. Give me 1 second. Okay, all right, ladies and gents. Thank you very much for joining me live. Actually, one thing I do want to show you is if you have signed up to the MACROACE mailing list, then I want to show you an example of what the email would look like. Okay, so I send out one email every week on a Monday, usually before the US session has begun, and this is an example of what you can get. Okay, so there isn't a lot of detail or breakdown as to what to expect for the week ahead, but I go through what to expect in Asia, Europe, and the US session. A bit of a summary of the weekend news, if there has been anything interesting. Links to the deviations and ranges, which of course you guys are looking for. And also the links to the live streams for the upcoming releases that we will be covering for the week ahead. Okay, but as said, you've got a little summary of breakdown there. It's supposed to be acting as like a refresher. So that's, but you do have some commentary from investment banks that are also included in that week ahead too. And the live streams with me here that we've been going through have also is where a lot of the detail is provided of what to expect from the markets, what to expect from the Fed or the Bank of England tomorrow. So yeah, it's short. It's supposed to act as a refresher. I'll work on a couple of the ideas. Send me an email of your ideas again, because I think I've kind of lost them. My brain is kind of going after a bit of a long day. But yeah. You're a little bit confused? In what way? How can I help? How can I unconfuse you? Yeah, so more or less there hasn't been any dramatic change. There wasn't any do you remember when I said that that if they do decide to go with 2 rate cuts instead, or fewer rate cuts this year, that could provide a hawkish stance of the Fed. Well, they stuck with their 3 rate cuts this year, and the markets was what they were looking for rate cuts in start in June. And also, if I go back, let's see, let me find it here, and traders pricing in additional Fed easing in 2024. So that's what's causing the momentum here. Is you have traders basically traders pricing in an additional amount of Fed easing this year, which helped to move the stock markets towards the upside. But yeah, so there isn't that much change really to what the Fed is looking to do for 2024 or 2025. So there isn't that much concern or that much change. Hence, you see a stronger market. Hence, you see a more bullish market reaction from the stock futures here. And also in 2025 as well, additional 75 base points seen in 2025. That's also helping to see provide some positive momentum to the stock market. Hopefully that answers your question. All right, you guys have a great night. Hopefully you did well. As I said, don't forget to give the video a like, share, and subscribe to the channel. I'm gonna have a bit of a lay down. And then we've got the press conference in about 9 minutes. So head on over to FinancialJuice if you've got the live version or the pro version. Enjoy it. James and Co. Will do great. As I hope they did with this one. So yeah, all right, take care.